I'm Sarah Borgeson-Keto with NAREITsREIT.com, and I'm here in New York City for REITWeek 2016, NAREIT's Investor Forum. I'm joined today by Ken Campbell, co-founder of CBRE Clarion Securities. Welcome, Ken.
Thank you, Sarah. Glad to be here.
So, Ken, as a long-time observer of the REIT market, do you think that the industry still has room to grow?
I looked the numbers up, and they're absolutely astounding. 10 years ago, the REITs distributed $13 billion of dividends. Today, it's $40 billion a year in dividends, and that's the United States alone. So triple the amount of REITs. The specific REITs has gone up by about 20%, but the market value has gone up by about 150% over that 10-year period. I don't see anything that's going to upset that. We'll have some bumps along the way, but we're going to grow.
So, Ken, in your mind, what are the characteristics of the most successful REITs?
Value for shareholders. I remember Martin Buxbaum. That was always the thing that he wanted to do. He was the biggest shareholder, and so he wanted to create value for the shareholders. Focus on property quality, competitive quality, the ability for his properties or their properties to withstand the shocks of any system that comes along. And then lower leverage, debt. Lower leverage equates to higher yield, lower cost of capital, gives you a competitive advantage, a major competitive advantage. So public REITs are in the business to create a lower cost of capital because that's the way they can grow. So those are the three big things. There's no magic to them, there's no secret to them, but just a focus on the shareholders, strong balance sheets, and very, very, very high quality of properties.
And in your new book, you make the case that the modern REIT industry has softened the impact of the real estate cycle. Could you explain why?
Well, I think it boils down, in my mind, okay, and to two things. Data, a heck of a lot more of it, and debt, a heck of a lot less of it, okay? And I'm taking a long view, thinking back to the real estate world of the 60s and the 70s, where debt was everything. You levered everything up, and data was almost non-existent. And so, and I mean, by data, I mean real estate data. Property-specific data, city-by-city market data, and so forth. If you look at the world today, you got 3 dozen, give or take, investment banks pumping out data every day. That data is out there in the marketplace. Developers obviously see the data, and so it leads them, I think, to make better informed decisions on building new properties. And so what has happened in the last 10, 20 years is that new construction as a percent of the existing stock has fallen, probably from say 3% down to maybe 1%, 1.25% in today's world, and that reduces risk in the market, and reduced risk lengthens the cycle. So the cycle has been, in my mind, tamed by the really outpouring of data, which reduces risk in the development cycle. So to my way, I think it's a very simple equation, and we've had a cycle now that's been going on for 8 years. Real estate this cycle would probably go on another 2-3 years, 4 years, who knows? And I think the amplitude of the cycle is lessened by those two factors. So I see it as the cycle is tamed a heck of a lot by more data, less debt.
Thanks very much, Ken, for all your insights.
You got it. Thank you.
And for more information on REITweek 2016, be sure to visit REIT.com.